This is not financial advice, educational content only. When a deal closes, the headline is usually a dollar figure: company acquires target for $18 billion. What the headline never tells you is where that $18 billion ends up on the balance sheet. And the split between identifiable intangibles and goodwill is one of the more information-dense decisions in an acquisition filing. This episode is about reading that split. We're going to walk through what a 10K's intangibles footnote actually contains, why goodwill sits there indefinitely while everything else decays, and what the disclosure language tells you about how much faith to place in the number. We're not evaluating whether any deal was a good idea. We're looking at how to read what the accountants were required to put in writing. Under ASC 805, the Business Combinations Standard from the Financial Accounting Standards Board, an acquirer has to allocate the full purchase price across everything it bought, every identifiable asset and liability measured at fair value. The process is called the Purchase Price Allocation, or PPA, and companies have up to a year after deal close, called the measurement period, to finalize it. What gets identified separately: patents and developed technology, customer relationships, trade names and trademarks, non-compete agreements, order backlog. Each is valued individually, typically by an independent valuation firm, and each is assigned a useful life. Everything left over, the excess of purchase price over the fair value of net identifiable assets, becomes goodwill. This matters because goodwill and identifiable intangibles are treated very differently going forward. One decays on the income statement over its useful life. The other sits on the balance sheet indefinitely, subject only to an annual impairment test. The split between those two buckets is one of the most informative things a deal filing tells you about what the acquirer believed it was actually buying. Open the 10K for any acquisitive company and look for the intangibles note, typically titled Goodwill and Other Intangible Assets, in the notes to financial statements. You'll find a table with gross carrying amount, accumulated amortization, and net book value for each category: customer relationships, developed technology, trade names, licensing agreements, non-competes. Most of these amortize. Customer relationships commonly carry useful lives between 5 and 20 years depending on the business. Developed technology often amortizes faster, in the 3 to 10-year range. Order backlog can run off in under a year if the acquired backlog was short cycle. The useful life assumption is worth reading carefully. A company that assigns 18 years to customer relationships is making an implicit claim about the durability of the revenue it acquired. One that assigns 7 years is making a different claim. Neither is automatically right. It depends on the underlying business, but the assumption flows directly into future amortization expense, and therefore into the gap between GAAP earnings and the adjusted earnings the company typically leads within press releases. For heavy acquirers, that gap can run to hundreds of millions of dollars per year in the P&L. That's my read. Goodwill under current GAAP does not amortize. This is a meaningful departure from the prior standard, under which goodwill was amortized over periods up to 40 years. Since the FFSB's ASC 350 took effect in 2002, goodwill instead sits at its original acquisition era value until it is written down through impairment. What goodwill represents is the residual, the premium the acquirer paid for things that can't be individually attributed. Assembled workforce, institutional knowledge, expected synergies, strategic positioning. These are real economic factors, but they're not separately identifiable under the accounting standard, so they're pooled into one line. The result is that goodwill as a percentage of total assets is a proxy for acquisition intensity. For software and healthcare services companies that have grown primarily through deals, goodwill plus identifiable intangibles can exceed 60 to 70% of total assets. That means the majority of what appears on the balance sheet is a number derived from what someone paid for something in the past, not from current productive assets. For a business generating strong free cash flows, that balance sheet structure can be entirely defensible. For a business where acquired cash flows have underdelivered, it represents a significant shelf of value carried at acquisition era prices. That's my read. ASC 350 requires companies to test goodwill for impairment at least annually or whenever a triggering event suggests the carrying amount may not be recoverable. The test happens at the reporting unit level, typically the segment level or sometimes a subdivision within a segment. The mechanics: if the estimated fair value of a reporting unit falls below its carrying amount including allocated goodwill, the company records an impairment charge equal to the difference. Fair value is typically estimated using discounted cash flow models, market comparables, or a combination of both. Because the test depends on management's assumptions about discount rates, terminal growth rates, and projected margins, goodwill impairments have historically been lagging indicators rather than leading ones. Work documented in accounting research from the early 2010s examining post-ASC 350 impairment patterns found that charges tend to cluster in down cycles, confirming stress the market had already priced rather than surfacing it. A large impairment in year 3 or 4 of an acquisition is usually the accounting acknowledgement of a deal that showed fundamental trouble earlier. Under ASC 350, companies may also elect a qualitative assessment, essentially asserting that fair value more likely than not exceeds carrying value, without running the full quantitative model. When a company uses the qualitative bypass and doesn't disclose detailed assumptions, you're relying more on management's assertion than on a documented calculation. The most actionable disclosures in goodwill accounting are the ones about headroom, the cushion between a reporting unit's estimated fair value and its carrying amount. Some companies disclose this explicitly: the fair value of the reporting unit exceeded its carrying value by approximately 35%. Others use vaguer language: fair values substantially exceed carrying values, and some disclose explicitly that specific reporting units have limited headroom. That last category is the most useful. When a 10K states that the fair value of a particular reporting unit is not substantially above its carrying value, that's an explicit early warning embedded in the footnote. Note the reporting unit name. Read the same disclosure in the following year's filing and check whether the language tightened or eased. Also worth tracking changes in the valuation assumptions disclosed from year to year. A company that was using a 9% discount rate and shifts to 10% the following year is implicitly marking down the present value of its projected cash flows. If goodwill holds steady in that same year, other assumptions in the model are carrying more weight. None of this tells you what any company's shares will do. What it does tell you is where management has embedded optimism in the balance sheet, and where the accounting standard has given them the discretion to hold it there. That's my read. The real tool from this episode: next time you open a 10K for a company that's made acquisitions, go directly to the intangibles footnote, usually labeled goodwill and other intangible assets in the notes. Check the useful life assumptions for customer relationships and developed technology. Find out whether the company ran a quantitative or qualitative impairment test and whether any reporting unit discloses limited headroom. That's the note to revisit in each subsequent annual filing. This isn't advice, it's a way of looking. If the framing helped you spend 20 minutes with a footnote you'd have otherwise skipped, that's the win. I'm Diane, back next briefing.